In 2025, the world is facing a lot of problems. Recession, inflation, rising interest rates, war, conflict. All these things shape our economic lives. So how do we make sense of them? What if everything you thought about the economy, inflation, recessions, growth, crashes, could be traced back to one simple idea? What if the economy is a machine? Not a machine that perfectly serves society, but a machine nonetheless. A machine built on human behavior, structured by incentives, and powered by time. This machine isn't perfect. It doesn't always run smoothly, but it is understandable. And once you see how it works, you'll never look at the world the same way again. Today, we break it down in full. Let's start with the basics. The economy is about trade. It's you buying coffee, your employer paying your salary, a company investing in new equipment, a government issuing bonds. These are all exchanges. Money for goods, credit for labor, promises for future payment. Every transaction has a buyer and a seller. One side spends, the other earns. When you put all these individual transactions together, millions of them per day in a single country, you get an economy. Now, the size of an economy is measured by something called GDP, gross domestic product. It's just the sum of all these transactions over a period of time. When GDP rises, the economy is growing. When it shrinks, the economy is in decline. But the important part isn't the number, it's why the number moves. Most of the economic movement you see, especially in the short term, doesn't come from productivity. It comes from credit. Credit is just borrowed money, and it allows people and businesses to spend more than they earn. For now, imagine this: you make $50,000 a year, but get approved for a $250,000 mortgage. You now have the ability to make a massive purchase, a home, even though you haven't earned the money yet. That's credit in action. Credit increases immediate demand, but it comes with a cost: debt. That debt must be paid back with interest, which means future spending will have to go down. This gives rise to the short-term debt cycle, which usually lasts around 5 to 10 years. It looks like this. Easy credit gives increased spending, gives economic expansion. Rising debt gives higher repayments. Slowing growth, less borrowing gives less spending, gives economic contraction. Central banks intervene. Lower interest rates gives restart cycle. These cycles happen over and over again. Think of them as the heartbeat of modern economies. Enter central banks. Institutions like the US Federal Reserve, the European Central Bank, the Bank of Japan. Their job is to keep the economic machine running smoothly. Their tools: interest rates and money supply. When the economy slows, central banks lower interest rates to make borrowing cheaper and stimulate spending. When the economy overheats, they raise rates to prevent bubbles and control inflation. But there's a limit. Once interest rates hit zero, or close to it, central banks lose one of their main tools. That's when they turn to more extreme measures. Quantitative easing. Quantitative easing means creating new money digitally and using it to buy financial assets like government bonds or mortgage-backed securities. This injects liquidity into the system and keeps markets functioning. You may have heard this called money printing, and in a way, it is. During the 2008 financial crisis and the COVID-19 pandemic, central banks around the world created trillions in new money to stabilize their economies. While short-term cycles come and go, each one usually leaves behind a little more debt. Over decades, this debt accumulates. Eventually, a society reaches a point where total debt, private, public, corporate, becomes too large to manage. This is the beginning of the long-term debt cycle, which plays out over 75 to 100 years. In the early phase, debt helps grow the economy. But in the late phase, servicing the debt becomes a drag on growth. At this point, governments and central banks face impossible choices: cut spending that causes recession, that slows investment and fuels political unrest; default on debt, that risks collapse; print money, that creates inflation. Most often, they choose to inflate the debt away. This means creating new money to pay off old debt. Over time, this reduces the real value of what's owed, but it also reduces the purchasing power of money. That's why groceries cost more today than they did 10 years ago, even when wages stay flat. If inflation gets out of hand, it can destroy savings, erode trust in currency, and destabilize societies, as seen in Weimar Germany in the 1920s, or more recently in Venezuela and Zimbabwe. This brings us to a fundamental balancing act: inflation versus deflation. Inflation means rising prices. It helps borrowers by reducing the value of their debt over time. Deflation means falling prices. It rewards savers but discourages spending and investing. Both can be dangerous if extreme. During the Great Depression, deflation made it nearly impossible for businesses to grow and created a vicious cycle of falling wages and collapsing demand. During the 1970s, stagflation, high inflation combined with stagnant growth, paralyzed economies and forced painful rate hikes to restore stability. Central banks today aim for a Goldilocks zone around 2% annual inflation. Not too hot, but maintaining this balance is becoming harder, especially with aging populations, rising global debt, deglobalization, and growing political polarization, you may have noticed we haven't talked much about productivity. That's because in the short to medium term, it's not very useful for smoothing out the cycles. But in the long run, productivity is the only way to grow an economy sustainably. Productivity is about doing more with less. It's powered by innovation, technology, infrastructure, education, and human creativity. When a farmer goes from feeding 10 people to 1,000 people because of new tools, this productivity. When an AI algorithm can process millions of legal documents in seconds, that's productivity. In the long run, productivity is the only way to grow an economy without increasing debt or inflating money. It is why the average person today lives better than kings did centuries ago, with access to healthcare, electricity, transport, and global communication. So you can think of the debt cycle as a wave that pushes economies forward and backward, while productivity is a current that pulls them higher over time. Here's the chart we teased earlier. Let's go through it step by step. Phase 1. The upward trend. As a country develops, it starts to take on more debt. At first, this debt is used productively, helping the economy grow faster than it would have otherwise. Investors are willing to lend to the government at low rates because the risk seems low. People feel wealthier and more confident about the future, so they take on more debt. 2. Which boosts demand even further. Governments often run deficits during this phase, meaning they spend more than they earn. They don't worry about this because the economy is growing quickly and the debt is manageable. But as the cycle continues, phase 2, debt takes over. Borrowing becomes cheaper and easier, so everyone takes on more debt. Governments may increase spending to fund social programs or infrastructure projects, but now the economy is starting to overheat. Wages are rising faster than productivity. Asset prices are booming and investors are taking on huge risks. Central banks may intervene to raise interest rates and slow demand, but by now, people have gotten used to easy credit. They start to panic if rates go up, fearing that it will stop the economic growth they've come to expect. Politicians often try to keep the party going by promising tax cuts but this just adds to the debt burden. As the bubble gets bigger, phase 3, the burst. Eventually, something breaks. Maybe it's a financial crisis, a recession, or a war. Now investors want higher returns for taking on more risk. Borrowing gets more expensive and the economy starts to slow down. Governments might try to help by issuing more debt, but now lenders are starting to worry. They cut back on lending and the economy falls into a recession. And as the downturn deepens, phase 4, economic hardship can last for years or even decades. People struggle to pay their bills and companies go bankrupt. Trust in financial institutions erodes and people lose faith in the economy. This is often the time when big changes happen. New industries emerge, new technologies are developed, and new leaders take power. Eventually, the economy begins to recover. But it's different now. The old ways of doing business no longer work. The old debts have been cleared away, and the economy enters a new phase of growth. We hope that helps. Next time you hear about economic news, here's what to look out for: quantitative easing, inflation, debt levels, wage growth, and productivity. Now you know the key variables and how they interact. Just remember, economies are complex, adaptive systems. There are always surprises and unexpected events. The best you can do is understand the normal cycle and keep learning. Thanks for watching this episode. If you enjoyed it, please share it with a friend. We'll see you in the next one.